In this video, I would like to discuss special accounting issues that could arise with revenue recognition. This particular video addresses sales returns and allowances and then repurchase agreements. Let's take a look for sales returns and allowances. Customers could be granted a return policy for various reasons, and as a result, we can either give them a full or partial refund, or a credit that could be applied to the amount owed, or we can offer them another product. Let's first address credit sales with returns and allowances. In January of 2020, Vanden sold 100 cameras for $100 each, and we allow to return any unused cameras within 45 days of the purchase. The cost of each product is $60. We estimate that 3 products will be returned based on our historical information that we have. The cost of recovering the product will be immaterial. So basically, we will get our cameras in the original packaging. We don't have to rewrap them or do anything with them. And then we can sell the returned products at a reasonable profit as we originally planned. On January 24th, 2 cameras were returned because they were the wrong colors. And then January 31st, we prepare our financial statements. Let's take a look at what it's going to look like as far as the journal entries. So here is your sale. And again, these are credit sales, so we will debit accounts receivable for $10,000, 100 cameras at 100, and record sales revenues. So we assume the sale, in fact, occurred. And then if you remember from perpetual inventory system, you will debit cost of goods sold at $6,000 because your 100 cameras cost us $60, and you're going to credit inventory. Then later in the month, on the 24th, 2 cameras came back. So we will employ a debit to a contra revenue account. If it's a contra revenue, then normal balance for that account is a debit. So if I debit that account, it will go up. And credit will be to accounts receivable since it was a credit sale. And we will open up a new account called return inventory. So we're going to debit our return inventory at 2 cameras, $60 each, and then credit cost of goods sold to reduce that expense account. How about January 31st when we prepare our financial statements? First, we have to record or estimate 1 more camera that we expecting to get back. So we will again debit sales returns and allowance for 1 more camera. And this time we will not reduce our accounts receivable because we don't know for sure yet if it will be returned or not. So we will actually create a brand new account that is called allowance for sales returns and allowances. And that account is a contra accounts receivable account, so contra asset. Therefore, the normal balance for this one is a credit. Please recall that we have a very similar account that is also contra asset, a contra account receivable, that is called allowance for doubtful accounts. But that's a different type of allowance that we are setting up. And then we will also debit inventory returns at $60 for 1 more camera and reduce our cost of goods sold. That's what our financial statements will look like. As far as your income statement, you will have, it doesn't show up, unfortunately. My first line somehow is not showing up. You should have sales for all the cameras, 100 cameras and $100 each, or $10,000. Then less your sales returns and allowances, we allowed for 3 cameras total, so $300. Then cost of goods sold, we assume 97, not 100. Were sold, and here's finally our gross profit. What about the balance sheet? And again, for some reason, my accounts receivable account is missing right here. And we will subtract the allowance for sales, returns, and allowance. That's that 1 extra camera. So we started with $10,000. Then we had to reduce accounts receivable by $200 because 2 cameras were indeed returned. And then we had to subtract $100 for one more camera that is expected to be returned. So accounts receivable net is $9,700. And then also on the balance sheet, you will have your returned inventory at $180 for 3 cameras. Now we're going to switch up to cash sales. So the transactions will be very, very similar to your credit sales, except when the sale occur, instead of debiting accounts receivable, you will debit cash. The rest for the sale is the same. What about when we get the return and sell itself? Recall that we credited accounts receivable. Well, in this case, we're not crediting cash. We have not given them cash yet. So instead, we will go ahead and credit accounts payable, recording it as a liability on our part. And then we will have to estimate a return for one more camera, again a debit to sales returns and allowances, and we will credit or increase our liability in accounts payable by one more potential return that might happen later. And here is again your financial statements. Look very much alike. The only difference will be is this accounts payable account that got created. So we don't have an accounts receivable because those were cash sales, but we do have a liability set up for $300. Let's now take a look at repurchase agreements. So what are those? Repurchase agreement allows company to transfer an asset to a customer, but then have an unconditional or forward obligation or an unconditional right, call option, to repurchase that asset on a later date. If obligation or right to repurchase is for the amount greater or equal than the original selling price, then FASB considers this transaction is actually to be a financing transaction, as if you actually borrowed the money and gave them an asset, almost like as a collateral. So let's take a look what it's going to look like. In this repurchase agreement, Morgan, an equipment dealer, sold equipment on January 1st, 2020 to Lane for $100,000. It agrees to repurchase that equipment on December 31st, 2021 for a price of $121. Assuming an interest rate of 10% is imputed on this agreement, on January 1st, we will record the following journal entry. Debit cash, so Morgan got cash, but it will record not a sale, but rather a liability to Lane Company. Then at the end of first year, so December 31st, 2020, we need to accrue interest expense. Remember, we applied a 10% borrowing rate built into this transaction. So we will take our liability of $100,000, multiply by 10%, and multiply by 1 year, so annual 10%. We will record interest expense of $10,000 and then liability of $10,000 as well. Now, a year later, up here, we will have to record 1 more year worth of interest expense. But look at the liability. It's not $100,000 anymore because the liability went up by $10,000. We have $110,000 multiplied by 10%. We have $11,000 interest that we will have to debit and increase liability as well. And then finally, as the asset goes back to Morgan, Morgan will pay back $121,000 in cash and take off the books the liability of $121.